Okay, the recording is on. Hi, everybody. Today is 4th of July, 2023. We are meeting here today to the webinar called Navigating Some Inherent Contradictions in CBDC. And this is a presentation that was scheduled to have happened a couple days back on Wednesday, 21 June 2023 at a conference, an LPFMI conference in Frankfurt. But for various reasons that couldn't happen. So we're making up for it. So how we're going to do this is we're going to have a 20-minute or so presentation and then followed by a 10 minutes or so discussion. And what I'm going to be doing now is I'm going to introduce the presenter. So we're glad to be able to now make up and have online Georg Pantelopoulos. And he had attained his PhD in economics at the University of Newcastle, Australia, and is completing currently a book on payments and financial market infrastructure with Ulrich Bindseil from the European Central Bank. And Georg was also a presenter at the LPFMI Liquidity Project Financial Market Infrastructure Spring 2022 workshop in both Frankfurt and London online. And Georg, we're looking forward to what you have to say. The floor is yours.
Thank you very much. Thanks for the lovely introduction and thanks for attending the webinar. I'll just share my screen. Hopefully, hang on. Hopefully you can all share, see my screen okay? No problems there?
Yes,
you can all hear me okay? Cool. So, yes, as Kiko mentioned, in my work with Ulrich Bindseil from the ECB, I started actually giving a bit more attention to this idea of CBDC, what would it look like? So that sort of really, focused my attention on this topic. And I sort of started thinking about some of the discussions that have been had in the sort of academic literature around CBDC. And I started actually, thinking about it. It seems like every sort of second paper I read in the sort of the payments sphere or the money sphere is around CBDC. So I thought I'd contribute in that sense. The topic of CBDC has been around for a while, but I guess it's really, really intensified, particularly even since COVID. So there was an even larger decline in cash, use of cash during COVID for obvious reasons. So electronic payments really, really took off even further than what they have been. So I started thinking even more about CBDC, and it really comes down to sort of three questions to my mind. So that's what the talk will be structured around, these sort of three key questions. Time permitting, I'll sort of showcase a solution with cross-border payments as well, if I have enough time. So unlike sort of domestic payments, where I can pick up my phone, for instance, and send money to someone and I'll receive it within maybe 2-3 seconds, cross-border payments are a lot more complicated and then they're typically not instant. So the paper essentially, as I said, will cover these sort of three questions. So should CBDC be issued, or in other words, why? Why should CBDC be issued? So there's been a lot of chatter around, the design of CBDC, but I'm thinking, the first key question is, what's the point of it? Why should we actually care about issuing a CBDC? So that's the first question. Second question is, how do we actually deliver CBDC to end users, as in private citizens, us, the general public? And the third question is, should CBDC be account or token based? So I'll attempt to sort of reconcile these three questions. And then, as I said, if I have time, I'll do the cross-border payments sort of example. Okay, so what is CBDC? Right, what is CBDC? So when we think about it, our money, it's also obviously a store of value, unit of account, but it's a means of payment. So really there's two forms of means of payment. It can be account-based or token-based payments, or a token-based means of payments. So most of us nowadays, we use account-based means of payments. In other words, something like our bank deposits, and it's an account-based means of payment. When we think of an account-based means of payment, we're actually sacrificing anonymity. Okay, so if I actually make a payment, so if I buy a coffee with, say, my debit card, which is working as the payment instrument, which is actually triggering the payment, my anonymity is actually sacrificed, because for me to actually make a payment, I have to, in other words, the end user, me, I have to provide some sort of authentication to validate me as a person. So it could be a PIN, a password, which is, again, going to the nth degree. In Australia, for instance, if a payment's below, I think it's $200, you don't even have to put in your PIN or anything like that. Account-based payments, we also need connectivity to some sort of payment network, right? It could be an internet connection, so which really means that payments, we can only execute them online. And for settlement, we need some sort of third party. So we need some sort of third party to actually sit between the payer and the payee to actually effectuate or bring about settlement. So that's account-based means of payments. Second type of means of payment is token-based means of payment. So something like banknotes. Okay, so with banknotes, if I'm actually making some sort of payment, there's no sort of identification barrier that needs to be surpassed, because I'm holding the actual means of payment, the token, the banknote, or cash. Okay, so when I'm actually paying with a token-based means of payment, it's essentially peer-to-peer validation, which, okay, I don't need a third party, but then it raises the question, okay, the token's being validated by the payee, the person receiving the banknote. How do they know that the actual token is legitimate or not? And with token-based means of payments, settlement is essentially instant. Okay, so, and settlement is offline. Payments are all offline. So I don't need to be connected to some sort of payment network. Of course, the only precondition is the payer and the payee need to be physically close to one another. So what is CBDC? Just continuing on. So in terms of account-based means of payments, obviously nowadays we've got commercial bank money and central bank money. Right, so commercial bank money would be deposits with a private bank. I've listed some Australian banks here. So things like ANZ and the Commonwealth Bank. So Australia, New Zealand Banking Group and the Commonwealth Bank. They're just some, two of the biggest 4 Australian banks. Commercial bank money. We've also got account-based central bank money. So deposits with the central bank. So unlike commercial bank money, with central bank money, there's no inherent credit risk. The central bank can't default on any liability denominated in the domestic currency. But as private citizens at the moment, we only have access to account-based commercial bank money. Okay, we only hold token-based central bank money, in other words, banknotes. So if a CBDC was going to be introduced, as private citizens, we would actually have access and be able to hold account-based central bank money, as opposed to only account-based commercial bank money, as is the current construct. So why CBDC? What's the point of CBDC? So one train of thought is due to the rise of things like crypto assets. Crypto assets essentially are, when we actually think about it, something like Bitcoin. Okay, so in its purest form, Bitcoin is actually not a claim on any sort of counterparty. Okay, stable coins really are sort of some sort of backed crypto asset. Okay, so the most prominent example would be the proposal of Facebook, of Libra, which the name was later changed to DM. But stable coins, according to the definition provided by the ECB, they're not in fact crypto asset because they have some sort of identified issuer. In other words, if I'm holding a stable coin, it's still a claim on some sort of counterparty. Whereas Bitcoin, it's not a claim on any sort of counterparty. What's actually backing Bitcoin is the actual blockchain itself. So what's the actual point of CBDC? So my argument would be, well, it's not really got to do with stable coins or the rise of Bitcoin or anything like that. In my opinion, the real reason for why we sort of should think about CBDC is as follows. So we know that banknotes are declining as a means of payment. So consider this for a moment. We've got 2 banks, ANZ and the NAB, so Australian New Zealand Banking Group, and the NAB, 2 Australian banks. And let's say it could be different people or one person has $100 worth of deposits in each of these banks. So in other words, I've got $100 at the ANZ, which is backed by $100 worth of reserves. And I've also got $100 worth of deposits at the NAB, which is backed by $100 worth of reserves. So the question is, what's actually making that $100 in one account actually equal to $100 in the other account? What's actually the thing that's actually linking the two? And in my opinion, the thing that's actually linking the two is this idea of convertibility. So as a private citizen, I could go nowadays, probably not into the bank, but at some ATM, and I can actually withdraw that $100 out of each of those banks into central bank money, into a banknote. So here we've got $100 Australian banknote. So this idea of convertibility is really, when we actually think about it, the idea of convertibility. In other words, the central bank money is acting as the anchor to commercial bank money. And so what it's actually doing, if I have convertibility, that actually means that these privately issued IOUs, in other words, this IOU, this privately issued IOU from ANZ and this privately issued IOU from the NAB, it's ensuring fungibility. It's in the idea that I can actually convert each of those into $100 cash, is meaning those two privately issued IOUs are actually fungible. Okay, so it's resting on this premise of convertibility. So if I actually couldn't convert those $100 into the cash, that could lead to a loss of fungibility. So let's say, for instance, if everyone stopped using cash, cash was still available, but actually everyone stopped using it, then this idea of convertibility could turn into some sort of theoretical as opposed to real world construct. Okay, so even if cash was still being issued per se, what would be the point of me actually holding cash if I knew that potentially somebody else wouldn't accept it as a means of payment? Right, so the idea of convertibility, if it turns into some sort of theoretical as opposed to some sort of real world construct, then in my opinion, this could lead essentially to commercial bank money becoming de-anchored, as it were, from central bank money, and lead to a loss of fungibility. Okay, so again, when we think about it, it's some sort of, the central bank money is providing some sort of pseudo cross exchange rate between two types of commercial bank money, one-to-one. So that's in my opinion, that's the idea of, well, what's the point of CBDC? Well, what's the point of potentially issuing a CBDC? It's to retain the fungibility of privately issued IOUs. So that's the first question. Why should we actually issue a CBDC? Some arrangements for CBDC. Okay, so if we want to try and replicate the characteristics of banknotes, of token-based means of payments, how do we actually do that in the digital space? Okay, it's actually very difficult in practice to do this. Right? So does that mean that the central bank just opens up deposit accounts for the general public? Does that mean that if we're paying in CBDC, does that mean that payments are anonymous? In other words, anonymity is retained, just like banknotes. Does that mean we can make payments feasible in the offline space? So is it possible to pay in CBDC without an internet connection? Because central bank money, there's no credit risk. How do we then actually prevent runs into CBDC from conventional deposit accounts? Okay, so you can see it's not so sort of straightforward. So some general arrangements for CBDC. One option would be just a very, very simple construct, so like a single tier CBDC, where essentially the central bank just opens up deposit accounts for everyone, which technically is not hard. Central bank could just open up deposit accounts for private citizens. And so the central bank would complete all the sort of KYC requirements, AML, CFT, and all that sort of stuff. Historically, that wouldn't be anything new. The first central banks opened up in the 15th century. They actually opened deposit accounts for the general public. Okay, so it's nothing new. However, the central bank's probably very hesitant to do that because it's actually more efficient for the central bank to actually concentrate on its sort of core functions. So implementation of monetary policy, managing the payment system, as opposed to sort of the central bank spreading its sort of tentacles into all these sorts of areas. So according to all the literature and all the literature I've read, the most likely solution would be through some sort of two-tier CBDC. So when I was sort of thinking about this, well, I thought, well, how would that actually be done in the real world? So I like using financial accounts. So I thought I'd put my brain to this and think, how would it actually work through some sort of two-tier CBDC? So here I've just got some basic systems of financial accounts where I've got a trader A1, all in the same currency, Bank A, Central Bank A, and then I've got this two-tier infrastructure. So CBDC Tier 1 and the wallets Tier 2. So the idea is that to accommodate some sort of future demand for CBDC, what Bank A does is it actually has essentially a couple of accounts with the central bank. It's got its normal reserve account, so it's RTGS account, and some sort of general CBDC account. So if Bank A thinks, okay, I need to accommodate some sort of demand for CBDC, it actually just switches one form of central bank money for another. And so again, that's nothing sort of technically challenging. It's just switching one form of electronic central bank money to another. And so now it's basically swapped an amount. I've called it A1 in the amount of A, but I've called it A1 essentially since this is the first step. And so the central bank will essentially just debit the RTGS account of Bank A and just credit the CBDC account of Bank A. So now CBDC has been created. Okay, in some of the literature, they would essentially call this wholesale CBDC. So now comes the sort of two-tier infrastructure. So these sorts of two-tier infrastructures are essentially an extension of the central bank balance sheet. Okay, so here, my A1 appears on the central bank balance sheet. It also appears in the Tier 1 infrastructure, okay, which is here in CBDC. So what happens now is, okay, Bank A realizes that potentially trader A1, this private citizen, is going to want a stock of CBDC, again in the same amount, just to keep things simple. So what Bank A does is it actually transfers this CBDC within its Tier 1 infrastructure to its own wallet. So now it's in the Bank A's own wallet, the CBDC. But because I'm making an assumption here and I'm saying, well, the Tier 1 and Tier 2 infrastructures are actually interoperable. In other words, they can talk to one another, right? The same amount appears in the Tier 2 infrastructure down here, okay? This is essentially completing the issuance phase of the CBDC, what I've called it. And now there comes the point where the CBDC can actually be distributed to end users, me, yourself, private citizens. So now Bank A actually just essentially changes the distribution of the CBDC or the ownership of the CBDC from itself to the individual trader, and the distribution phase is completed. So essentially what's happening is that in all these steps, the central bank digital currency is still a direct liability of the central bank. So I've read there's been some other proposals like, I can't remember the names off the top of my head, but some like things like hybrid CBDC, or we have these ideas where we have, for instance, a bank issues CBDC, so-called CBDC, or some sort of CBDC stablecoin, which is backed by reserves held at the central bank. In my opinion, that's not actually CBDC, because if you're holding, as a private citizen, if you're have a claim on a bank, that's essentially commercial bank money, not central bank money. Okay, whereas here, the private citizen still has a direct claim on the central bank. What's actually happening is that the central bank is distributing the CBDC, and then the bank is essentially distributing that central bank money to a private citizen. So that's some arrangements for some sort of two-tier CBDC, which reconciles the question, well, how do we actually deliver CBDC to the general public without actually sort of making the central bank open up deposit accounts for private citizens? The third question, well, can CBDC be token-based? Okay, so there's been much discussion around, well, can CBDC adopt account or token-based properties? And again, one of the reasons that from my perspective is a lot of people are advocating for token-based CBDC because they want to keep the same amount of privacy as with banknotes. So I've sort of thought, well, okay, well, how do I actually reconcile this sort of question? And what I talk about in the paper is, well, how do we actually differentiate the principal properties between token and account-based means of payments in terms of state of matter, identification, and settlement across two dimensions? In other words, the two dimensions are, well, do I need connectivity to a payment network or not? In other words, if I need connectivity, it's an online payment. If I don't need connectivity to the payment network, it's an offline payment. So first of all, online payments. And these are the three categories. State of matter, is it physical or digital? Identification, is anonymity preserved or is anonymity not preserved? And settlement, is it peer-to-peer or do I need some sort of intermediary? So with online payments, in my opinion, it's not very logical to argue that, well, in a sort of digital sort of space, is it sort of logical to argue that, the person holding the CBDC is actually holding something tangible? Can they actually pick it up? Like as in traditional token-based money means of payments, in other words, a banknote. So in my opinion, it's not logical to argue that. Right, we actually, have a claim on some sort of imaginary token to sort of give them or grant them the right to employ the means of payment, right? So it's not some sort of physical, tangible object I can pick it up. It's digital. In terms of identification, right, in an online payment, can payments in CBDC be anonymous or not anonymous in the online space? So if we were to adopt the idea of sort of anonymous payments, then my line of thought would be, well, we'd have to have some sort of construct or similar construct to Bitcoin, okay, where I can access my digital wallet by entering some sort of private key, which is not known to anybody but me, which is not going to reveal my identity. That has its own problems, because what happens if I forget my private key? So like if I hold Bitcoin, if I forget my private key, the show's over. But as far as I understand, it's been stressed that any online CBDC won't be anonymous, in the sense that, well, while the central bank won't directly have knowledge of who's holding individual holdings of CBDC, private intermediaries, if they suspect, for instance, some sort of fraudulent activities, they can pass this information on to the central bank. And what about settlement? Peer-to-peer or intermediaries? Well, if I'm having an online payment, it's actually impossible for some sort of online payment to be peer-to-peer. I need some sort of third-party intermediary to sit between the payer and payee to bring about a smooth exchange of claims and to avoid sort of illegitimate double spending. Okay, this, even in my opinion, I would argue this idea of peer-to-peer solutions, it's often argued that, well, Bitcoin is some sort of peer-to-peer solution. In my opinion, it is not, because you still need intermediaries. The miners are acting as the intermediaries to bring about settlement. So in the online space, I would argue it can't be token-based. What about in the offline payments context? Well, in terms of state of matter, it's thought that any offline storage of CBDC will have some sort of, hardware wallet, and that'll incorporate some sort of hardware element, card chips, near-field communications technologies. And this will allow payments to be done or completed without the payer or payee to be connected to the payment network. What about identification? So some offline payment, can I actually preserve anonymity? Okay, so this actually depends on the method of settlement. Is it peer-to-peer or do I need some sort of intermediary? So if I need, if it's peer-to-peer, then I can certainly preserve anonymity. Okay, but that raises the problem again of, well, is the actual token, is it legitimate? Okay, which raises the problem of double spending, right? Which is generally why we have intermediaries in the online space. As an alternative, there's some proposals around, well, settlement can be deferred until either the payer or payee reconnect to the network. But that actually goes against the idea of a token-based means of payment, because in token-based means of payment, settlement's instant, whereas this wouldn't actually be instant. And there's been some suggestions from the ECB that, well, the hardware wallets will be equipped with some sort of secure element to prevent some sort of illegitimate creation of offline CBDC. So in summary, just conscious of the time, in my opinion, it's actually not correct to argue that online CBDC will create some sort of, new token-based digital form of money. Once we need or require connectivity to a payment network, in other words, once a payment's online, we can't actually replicate the properties of token-based means of payments in full. While we can sort of integrate some sort of token-based elements, so we can have anonymous payments and peer-to-peer validation into some sort of offline CBDC, offline CBDC still doesn't qualify as token-based if we consider that from a state of matter perspective. Okay, so in a state of matter perspective, then it's still going to be some sort of digital claim. It's nothing tangible that I can actually pick up. So it's more, in my opinion, more applicable to describe online CBDC as some sort of account-based means of payment and offline CBDCs as some sort of digital bearer instruments. Just conscious of time, do you want me to stop there, or I can quickly go through the instant cross-border payment example?
So I think this is perfect to stop here for the moment. What I'm suggesting is that we go through these discussions by Ceci, and that will get us for sure until 11:45. Sorry, and the 45th minute, depending on where you are. And then we can, and that those who want to leave on the eyeball number can leave. But then maybe we add this at the end, or it's part of the Q&A. So basically get done with the discussion until the 41st minutes. And so I'll hand it over, I'd say, to Ceci. But before I do so, I quickly introduce her. So she is our former working group finance, law, and economics coordinator. She is an associate researcher at the European Banking Institute and a banking supervisor at the European Central Bank. She received her PhD in international law from Trento University. And with that, Ceci, I hand it over to you. We're looking forward to it.
Yep. So thanks a lot, Kiko, and thanks a lot for the great presentation. Sorry if you hear some Teams messages popping up. I mean, I closed the app, but some colleagues.
That's okay. I was wondering through my talk, I can hear my son running up and down the hallway. I thought, oh, I hope you can't hear him.
Okay, well, that's much, much more fun than the Teams popping up. But yeah, sorry for that.
I don't know.
Yeah, I know. I've heard different things on that too.
Hey, I'm not sure.
No, yeah, now I'm here in the office. Very boring background. Sorry for that. And but yeah, so again, thanks a lot for this very comprehensive presentation, and also very clear, let's say, in terms of how you have conceptualized and how you have perhaps let's say dissect these key questions on CBDCs. I mean, of course, the literature in the past, let's say, 4 to 3 years has been like growing so much, and sometimes it's really hard to perhaps to keep track, or just to put some order in the thoughts. I mean, considering all the working papers that are issued, plus the work done by central banks. And well, as you might know, also we had very recently, actually last week, I think it was on the 28th, that the European Commission finally issued these proposals on the digital euro. One is more focused on the, let's say, on the legal basis for issuance, and the other one it's more connected to, let's say, to the payment side of it. So I think it's also, I mean, I still have to go through the details of the documents, but yeah, those were like very, let's say, long-awaited documents, and I think that probably one of the reasons for this slight delay from the European Commission. I mean, now of course I'm just talking about the digital euro in particular, so I think the analysis of the paper is more, neutral, in terms that, I mean, George was not precisely speaking of a specific CBDC. So in my case, I'm a little bit digital euro bias in some way. But I think that actually one of the reasons for this delay, perhaps in developing this legal proposal, is connected to many of the issues that actually were raised during the presentation. And I think that actually one of the biggest perhaps points is in connection with this, with the key core, or the core question of the research in connection to this contradiction between the token base and the account base. And perhaps my main doubt here is in connection with how you have framed, let's say, the identification part. No? So I mean, you have clearly identified or differentiated between the online and the offline. And with the identification bit, let's say the question is around like anonymity or non-anonymity. But for example, in the case, yeah, as I said, now I'm more digital euro oriented, but in the case of the digital euro, the debate is more around the privacy issue and not the anonymity as such, because anonymity was basically rejected as a policy, let's say, objective, or as something that could be attainable, and precisely because of the reasons that you mentioned. I mean, first and foremost, in connection with online payments, this is something quite unattainable. So on the one side, from the state of matter, and also for the type of settlement. So if you go through peer-to-peer, then basically anonymity is killed, because you need, I mean, these three elements are, let's say, highly interconnected. So from a digital euro perspective, let's say anonymity was like ruled out from scratch, from these more practical points of view, let's say, but also from this is more on the technical perhaps side, on how to implement, and perhaps the contradiction between having intermediaries and ensuring this full anonymity. So this is more from this, let's say, more implementation or operational standpoint. But also I think in the case, or in the specific, let's say, legal framework and maybe, European context, while privacy was one of the key issues that actually, when the ECB back in 2020 issued this first, I think it was the first public consultation on digital euro, and privacy came out as like the big aspect. No, and I think European citizens are pretty much aware and conscious, and they're very, let's say, it's something that it's kind of very close to, let's say, the values from the European framework, and how this is protected, like in different, let's say, treaties, and then in national law, and so on and so forth. But at the same time, so even though privacy came up as the first concern from European citizens, then it was one of the first things that that the policymaker, and first the ECB, when this digital euro exploration phase started, but later on it was onboarded also by the Commission when issuing these proposals. This was completely, or the full anonymity was excluded for these technical reasons, but also for these other more legal aspects that were also highlighted in here in connection with compliance with also AML regulations. And so therefore, this is perhaps like this contradiction that emerges perhaps from, on the one side, like people's, let's say, feelings or preferences, or how they use, but then what is technically and legally feasible if we are indeed moving towards a more digitalized or a more digital-based means of payments. And actually, I mean, there was also a very interesting, I mean, very short presentation, I think, was a couple of months ago, also on digital euro privacy options. And this was clearly, let's say, addressed by the ECB, in the sense that this gradual shift to, they say, to digital payment implies by default less privacy. So so the point here, I think, is it was mostly perhaps on the terms of how this debate specifically on identification and putting between this anonymity and no anonymity has been presented here, because I mean, I see the point and this is clear. But I don't know if maybe this is something more, and it's something I was curious actually to ask if in the, let's say in the policy Australian debate, this was already framed in these terms, or whether, let's say, like full anonymity has also been ruled out. And because just to know if I am way too much permeated by the digital euro discussion and just, I don't know, focusing perhaps on this debate, or whether in other jurisdictions, perhaps this has been the same. And yeah, and also just a very, let's say, a very basic account of how, for example, in the, I mean, the words, let's say, anonymity and privacy appeared, for example, from the very initial digital euro report back in 2020, and the different key documents in this respect. Yeah, it was just for me to check, and for example, the question of anonymity was no longer like received, or was no longer included in the documents, and this debate was always framed around this issue of privacy. And in any case, I think it's, I mean, at least for the technological state that we have nowadays, this is impossible to guarantee, but we don't know whether perhaps in a near or not so near future, there might be some ways of actually ensuring this, let's say, higher level of privacy. I mean, closer to anonymity, but in the current like state of things, it's really impossible. So I basically agree with your diagnosis, but perhaps I was just a little bit more skeptical in the terms of how this anonymity and non-anonymity was framed. But again, perhaps this comes from a debate, or from like the discussions that are going on at the moment there. So I'm also curious to hear that. So yeah, for the time being, this is a bit it. I mean, I have like some other notes, but I think for the sake of time, it's really, yeah, I would like to know that. And yeah, of course, it's always good to have this historical perspective that you brought in. And as far as I know, also Ulrich is also very fond of this historical side of things. So it's very useful also to have this, and yeah, and just to see that everything is not like was born like yesterday with the CBDC debate, but also there are like really foundational aspects on how central banking money has worked and how this has developed throughout history, and that, yeah, we're not really reinventing the wheel. I mean, maybe just with different means, and different technologies, but some of the concepts are really there. So this helps a lot. So yeah, thanks. I'd be curious to hear a bit more about that.
Thanks for your thoughts.
George, wanna
yeah, thanks for your thoughts and comments. I mean, in Australia, so for instance, the RBA, there has been some chatter and some publications around CBDC, both on the sort of the wholesale and retail side. Probably not as much as, say, what the ECB has done. In terms of the question of, you know, whether the RBA is considering issuing a CBDC in the near future, I have spoken to a few people at the RBA. They are, yeah, working on different projects, but it's not really foreseeable sort of in the very near future. As far as I understand, probably the ECB is more advanced in that sense than the RBA. In terms of the question around anonymity or privacy, I guess it's maybe there was a sort of a conflation of terms there. Maybe I should probably adopt the term privacy or no privacy instead of anonymity and no anonymity. I guess, yeah, the point of this sort of section was to sort of think about, well, what are the properties of account-based means of payments and what are the properties of token-based means of payments? Because I was reading a lot of literature around, you know, token-based CBDC, and in my head, or to my mind, to adopt or to use the term token-based CBDC is incorrect. So that's where I thought, you know, I might sort of frame this discussion around sort of the three sort of key properties of different means of payments. So I guess that's where I was sort of viewing in terms of anonymity and no anonymity. And in terms of, you know, whether, well, the topic of anonymity in itself, for me personally, I'm not per se have anything sort of, you know, if I go on the internet, I have an IP address, I've basically lost my anonymity. So, and we don't really seem to have a problem with that. So why would we have a problem with adopting a means of payment which leaves a trace, just like we use commercial bank money now? So in my opinion, I don't really see the, you know, the idea that, or this huge problem that CBDC has to be anonymous because I jump on the internet every day and don't think twice about, you know, giving up my privacy or anything like that. So yeah, there's some, I hope that sort of answers your question. And yeah, in terms of the historical sort of discussion, yeah, it's good to look throughout history because I have a saying, you know, history doesn't repeat itself, but patterns of human behavior certainly do. So sort of what goes around comes around, or Back to the Future or something like that. So it's important to look at history as well because it provides important lessons. And sometimes we can gain insights from history for contemporary debates.
Yeah.
All right. So
No, I mean, yeah, no, just perhaps a very quick last point. I think, yeah, I think probably this very first reaction to the initial public consultation on Digital Euro, perhaps let's say put forth this more of feeling against, like, or why privacy came as like one of the first concerns. I mean, it's probably because at these early, let's say, stages of the debate, the question was whether, I mean, the central bank was supposed to, I mean, they are supposed to guarantee, let's say, that the euro or whatever other currencies are still, let's say, legal tender, and therefore everything was like this equivalence between, let's say, cash and digital payments was like put, let's say, at the same level or on the same foot. But again, I mean, as we see these differences on the properties and how this works, it becomes increasingly clear that, let's say, cash properties will never be able to replicate in the CBDC arena. So I think now the debate is a little bit more moderate in this regard, or perhaps these expectations have been lower precisely because the fact that the central bank is meant to guarantee perhaps this fungibility that you refer to, or which is also connected to the legal tender. So basically the faith that that you can basically settle your payment with this currency. And yeah, and perhaps at the early stages of the debate, things were pretty much put at the same level between cash and digital one. But now I think it's it becomes clear that it's not possible to keep this parity of properties across these two currencies. So I think this paper really sheds light on precisely this point and helps perhaps just smoothing a little bit these concerns and also these expectations from the public. Yeah.
That's sort of that's the idea I had in mind. Because even there's been a lot of even on blog posts and all these types of sort of mediums or media. There's still discussions around, well, you know, can CBDC be token based? And in my opinion, it's not correct to adopt or to associate CBDC as a token based means of payment. It cannot be. Anyway, yeah.
Great. And there's, of course, always the opportunity for the two of you to connect directly. I'd say let's do the following. Let's see if there are some Q&As. Those that have to leave, obviously, can do so. This was the act that was sort of advertised. But let's see if there are some Q&As in there, and maybe in that, once you answer them, George, you can add the bonus material to it. I certainly have one question for you where I think this cross-border payments could be, the slides you have could maybe use to answer it. And the question is, what do you make of this mBridge project that was done by the BIS Hong Kong hub? If you're familiar with it, the mBridge project by the BIS Hong Kong hub, the Monetary Authority of Hong Kong, together with the PBOC, then the Central Bank of Thailand and the United Arab Emirates, in which they said that they successfully did cross-border CBDC payments, and sort of helped put that in perspective. We had recently a scholar who put that in perspective of, let's say the US dollar losing some of its key currency aspects. And one way of it won't be the big change, but that it would maybe be a little bit of how this would then shift to, I guess, another CBDC. So I would be curious to hear your thoughts on this, if you have any, and let's see if anyone else has. Let's collect some questions. If anybody else has some questions.
Maybe I might just answer the first one, the mBridge. I remember reading something about that.
But I think that if there's no one else asking a question, I just want to give it some time. Let's make that the only question, and then after that conclude.
Okay.
Unless there's someone posting something in chats.
The mBridge question, I vaguely remember reading something about it. I can't exactly remember the details, but from memory, it may have been on the wholesale side as opposed to on the retail side. I could be wrong. I mean, this idea of, again, sometimes there's a bit of confusion around terms. So this idea of wholesale CBDC, I mean, when we think about it, wholesale CBDC already exists because banks hold digital central bank money with the central bank. I think what generally is implied by wholesale CBDC, where you have settlement based on some sort of DLT, so distributed ledger technology. And I think from memory that mBridge, I could be wrong, but I think that mBridge project was around this sort of space where banks are settling through cross-border payments through DLT. I could be wrong, I'm not sure. But yeah, that's one. I didn't include that in this presentation, but there is sometimes a bit of conflation of terms. Like you often hear this sort of, wholesale CBDC or retail CBDC. Like wholesale CBDC for me, it's a bit of a misleading term in many ways because wholesale CBDC already exists. What's generally implied, I believe, by wholesale CBDC is where you have settlement based on some sort of decentralized mechanism as opposed to some sort of centralized mechanism as how settlement's brought about now. So yeah, a lot of these projects like mBridge, and there's a few others, they're sort of, from what I can understand and from what I remember, they're sort of more based around where settlement is brought about through some sort of, distributed ledger technology. Whereas I sort of, in this paper, I sort of concentrate on more sort of like the retail end. So I don't really worry, for instance, how per se about the settlement sort of technology. Yeah, does that sort of, I hope that sort of answers your question.
Certainly helpful. Before you go to the slides, we have another question by Vibbo. So maybe I hand it over to you, Vibbo.
Sure, thank you, Kiko. Thank you, George, for the presentation. As you rightly mentioned, your presentation is focused more on retail CBDC rather than the wholesale one. So my question is with regards to retail one. What do you think could be the impact of an average user getting to understand clearly the distinction between central bank money and commercial bank money with the introduction of retail CBDC? As of now, an average user doesn't realize the difference because thankfully the stable monetary and fiscal systems in most of the countries maintain a par between commercial and central bank money. With the introduction CBDCs, the distinction is going to come clear?
I think well, first of all, thanks for your question. I think whenever I sort of think of these sorts of concepts, I always try and think, how would I explain it to my parents or to my wife, who aren't economists and who aren't really interested in it? So in terms of sort of trying to bring across to the public, how would I differentiate between commercial bank money and central bank money? Then usually I'd like to look at sort of explain a balance sheet. So if I have money in the bank, from my personal balance sheet, it's on the asset side. The money in the bank or my deposits in the bank from the bank's perspective is on the liability side. So the bank essentially, okay, we've got a commercial bank, it's commercial bank money. Okay, there's some sort of credit risk or default risk there.
Correct.
With central bank money, I just would bring across the fact that, well, okay, if I'm holding CBDC, the difference would be is that it's a liability on the central bank balance sheet, not on a private commercial bank. So
100%.
That's how I would sort of bring across the distinction. And the idea is that just like cash now, it's a central bank liability. I would say, well, okay, with cash, there's no default risk. The problem with, or credit risk, the problem with cash, of course, is that it's a pain to use. There's custody risks. And all that.
My question, George, sorry for interjection, but just in the interest of time, I'll tell you, my question is not how to explain to an average user, is when an average user learns that there is a credit risk associated with commercial bank money, which he or she wasn't aware until now, thanks to the power maintained, how would an average user react? Will it create a deficiency in the money multiplication system, which has been running for a few hundred years now?
So I guess that goes into the topic where how do we sort of stop, I guess, runs into CBDC?
Correct. Yes.
And that's I didn't consider that in this paper at all. I mean, one solution, I know I've read a lot and I've spoken a lot to Ulrich about this idea of tiering. So if I can earn, let's say, 5% on a fixed term deposit account in my current bank, and I can earn, let's say, 5%, just for argument's sake, and it's on CBDC, where would I hold my money? Well, the obvious answer is, of course, I would put it into CBDC because there's no credit risk. So then that begs the question is, well, can you design a system somehow where you're trying to essentially stop runs into CBDC? And the idea, so one of Ulrich's papers is on this idea of tiering, where you're trying to essentially stop runs into CBDC by essentially people that are holding CBDC, they incur some sort of some unfavorable interest rate. So if, for instance, I can earn 5% on a deposit account in my commercial bank, it may be 0% for CBDC, or could even be negative, depending on the spread between commercial bank money and central bank money. So that would be one way to do it. The other way is to simply impose restrictions on the amount that I can A, transfer into CBDC, or B, hold in CBDC. So just basically impose strict limits, whether that's per month, per week, that remains to be seen. But that would be some way of sort of getting around that problem. But that is an issue. Because, I mean, again, history repeats itself. That was in part an issue when the first sort of private deposit banks were around, because people realised, okay, and private banks back then were very, very unstable. There were huge runs back then into sort of the safest asset, which was precious metal coins. And that's the reason why the first central banks were actually invented, because the private banking system was so unstable. So I hope that sort of answers your question. I mean, this sort of paper didn't really delve into that, just because there's been a lot of literature, or some literature, around how do we actually stop that sort of idea of runs from commercial bank money into central bank money. And one way would be through some sort of tiering system.
Sure. Thank you. Interesting take. Thanks.
Great, George. Do you want to, I don't think there's any further questions. Do you want to put on record the bonus material? I certainly would want to listen to it and but depending on if you have time.
Yeah, sure, no problem. So just with the bonus material, I was going to talk about this idea of, okay, cross-border payments. So again, there's been a lot of work being done by both in the academic sense and sort of, like standard setting bodies, so the Financial Stability Board, Committee of Payment and Market Infrastructures. So that's this idea of, well, can we sort of introduce this idea of a competitive central FX conversion rate, which seems like a bit of a mouthful, but we can essentially just break it down. So what do we mean by FX conversion or foreign exchange conversion? So suppose I buy a good from overseas. So for example, if I buy a bicycle, so I ride a lot in the bush on a bike, so that's why I thought I'd choose a bicycle. So my deposit account, it's only in Australian dollars, but let's say the seller wants to be paid in US dollars. So when I actually go to pay, there's got to be some sort of FX conversion, okay? And this is actually done through correspondent banking system. So my bank, depending on the size of my bank, if it's quite a large bank, it'll actually hold a US dollar deposit account with the bank of the payee, the person I'm paying in the USA. Okay, so I'll hold an Australian dollar deposit account, and my bank will actually hold US dollars with a bank in the USA. And this is where we get this idea of correspondent banking. So what would happen in this particular case? So this is FX conversion without a central FX conversion layer. My bank would essentially debit my account, and then the US bank would actually debit what's called the Vostro account of my bank, and then credit the deposit account of the seller, the person selling the bicycle. So that's essentially FX conversion without some sort of centralized conversion layer. So what we could then introduce is, well, okay, we can then introduce this idea of a central FX conversion layer, where we've got this idea of, well, we can have large banking groups who have access to deposits at the central bank in both the jurisdiction of the payer and the jurisdiction of the payee. And these large banking groups all compete against one another to provide some sort of FX conversion quote. And what this is actually doing is, in reality, when we think about it, cross-border payments actually don't really exist. Like no quote unquote money ever crosses a border. Either an account's debited or credited. So this FX conversion layer, the cross-border payment essentially is just converted into a set of domestic payments on each side. So the easiest way to do it is just to have a look at some accounts. So this would be with the payment where the means of payment is CBDC. So let's suppose, okay, I've got trader A who's purchasing the bicycle and trader B who's selling the bicycle, and it's in the amount of A. Okay, so when we're actually, because it's actually invoiced in currency B, I have to convert it into currency A terms. So I've introduced this sort of exchange rate factor, where I beta, okay, and that's the number of currency A units I need to purchase 1 unit of currency B, so whatever the exchange rate is. So here I've got, okay, well, trader A, my buyer of the bicycle, is going to request that the payment be made with CBDC. So here I'm already assuming that trader A actually already has a stock of CBDC, so they've already converted some amount of commercial bank money into CBDC prior to this happening. So what happens now, Bank A is the PSP, the payment service provider. It debits the CBDC account of trader A. So if we look here, this is in the sort of the distribution layer of the infrastructure. So remember before I introduced this idea of tier 1 infrastructure and tier 2 infrastructure, which are interoperable, and all of that, because they're all central bank liabilities. There's nothing on the asset side. It's just an extension of the central bank balance sheet. So what would happen is, in this particular scenario, Bank A would actually debit the CBDC account of trader A, the person purchasing the bicycle, and it would actually move the CBDC back into its own wallets. So if you remember, if we cast our minds back to before, where Bank A actually moved the CBDC from its own wallet into the wallet of trader A, now essentially it's doing the reverse. It's reversing this. It's moving it back into its own into its own wallet. So that's why this appears here. And then what's happening is to actually complete the payment or the cross-border payment, Bank A is actually shifting on the wholesale end. It's actually shifting the CBDC to FX Bank A. So here I'm assuming I've got this banking group called FX Bank, who has some sort of or has a what am I trying to say? I've lost my train of thought. Has a presence in each jurisdiction, so nation A and nation B, and FX Bank is committed to provide the conversion. So what would happen essentially is all these banks would compete against one another. And so in this case, FX Bank has provided the cheapest quote. And through some sort of software, the software would automatically pick the cheapest conversion quote. So now Bank A has actually shifted the CBDC into FX Bank A's wallet. So if we have a look at FX Bank A, it has an amount in its CBDC wallet. And all that happens is it actually just incurs a liability or an intra-group liability vis-a-vis FX Bank B. So FX Bank B is obviously just a part of the banking group FX Bank, which is located in country B or nation B. And so now FX Bank B has a claim on FX Bank A, so this one here. And now FX Bank B actually just shifts the CBDC on the wholesale end to Bank B. And Bank B is the payment service provider of Trader B. In turn, so now Bank B's actually gained that bit of that stock of CBDC. And again, because it's in the payment has been invoiced in currency B terms, it just appears as A, there's no exchange rate factor here. It actually just ships the amount of CBDC to FX Bank B. Okay, and this actually appears down here in the tier 1 wallet. So here I've got, Bank B, and it's actually shifting, FX Bank B, sorry, it's actually shifting the CBDC to Bank B. And this is in the tier 1 infrastructure, which appears in the tier 2 infrastructure. So if you remember again before, this is essentially the CBDC being issued on the wholesale end. And now the CBDC is being distributed, if you like to think of it, on the retail end to Trader B. And so this is happening in the tier 2 infrastructure. And so Trader B actually accrues a stock of CBDC and it's lost a stock of real goods. And essentially this idea would be to make it instant. So it would be an instant payment, just like I can send money through my phone. I can make an instant payment to whoever and I'll receive it in 2 and 3 seconds. The idea of this sort of competitive centralized FX conversion layer just means you can have instant payments, basically, yeah, instant payments, so within 2-3 seconds, and in CBDC. And it's still competitive in terms of the banking groups are competing against one another to provide the cheapest conversion service. There are some caveats to this. So if we have sort of payment corridors which don't have very, very high volume, then banking groups may not be willing to actually provide this service. So there's those sorts of caveats that we need to sort of think about. And this is essentially based on the idea of sort of interlinking payment systems. So you have to have common frameworks in terms of common messaging standards and a few other complications. So there are a few caveats with this sort of solution, but that's one example of how you sort of make payments instant with CBDC. You could also do this with conventional commercial bank money as well, not just with CBDC. So the same logic applies. So hopefully it'll be accepted, but I've submitted a paper on these sorts of ideas to a journal, which hopefully will be published soon. But yeah, that's the idea of an instant cross-border payment through this idea of some sort of competitive central FX conversion layer. And this particular example is showing how it would be done in CBDC with some sort of 2-tier infrastructure.
George, thank you very much. That certainly is an interesting idea. I hope the journal sees the merit of it and adding to the conversation. Again, thank you for allowing us to make up for your originally scheduled presentation of yours in sort of about 2 weeks ago at the LPFMI 2023 conference in Frankfurt. And we were certainly delighted to hear it. I was certainly delighted. And as a small addition, the presentation before you and after you in Frankfurt were not recorded. This one obviously is, and I hope there will be some merits to it. Information about it will come as they are available, or will be available at the website on which this webinar was advertised, at the WiseEye website. So with that, I close the recording and look forward to a continued collaboration between you and LPFMI.
Thank you very much. Thanks for having me.